This is not noise. This is not volatility. This is not just another cycle. This is a serious warning for all silver stackers, because what is unfolding right now is not visible to the untrained eye. It is hidden in plain sight, masked by green candles, record highs, and headlines screaming prosperity. But beneath the surface, the foundation is cracking. We are living through a chronic debasement, not the loud kind, not the overnight collapse kind, the slow, suffocating kind. The kind that makes you feel wealthier while you are becoming poorer. The kind that convinces you everything is fine because your portfolio statement is higher in nominal terms. The kind that distracts you with numbers that go up while purchasing power silently disappears. This is the illusion. You are being conditioned to measure your success in a unit that is itself shrinking. You are watching stock indexes priced in currency that is losing integrity. You are celebrating gains that are not gains when measured against something real. And because the number on the screen is higher, you assume you are safer, but you are not safer. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. The problem is not volatility in silver. The problem is not a temporary pullback. The problem is not that the price dipped in January or that sentiment cooled off. The real problem is that the unit of account itself has been corrupted for over a century, and most people have no idea what that actually means. When your measuring stick is stretching and shrinking at the same time, how do you measure anything accurately? You cannot. Debt is simply currency with a timer attached. It is currency borrowed from the future with interest layered on top. And when debt explodes to levels that cannot be serviced without creating more currency, you enter a self-reinforcing loop. More issuance to pay old issuance, more expansion to service old expansion, more liquidity to prevent contraction. This is the everything bubble. For decades, financial assets have been inflated by this expanding system. Bonds were in a generational bull market. Equities were in a generational bull market. Real estate was in a generational bull market. Everything floated higher on the back of expanding credit. But cycles end. And when a bond bull market that lasted decades reverses, that is not a minor shift. That is a tectonic plate moving beneath the global financial system. Because bonds are collateral. Bonds are the base layer of leverage. Bonds are the assumed safety in portfolios. When the cost of debt rises and bond prices fall structurally, you are not dealing with a routine adjustment. You are dealing with the slow deflation of the greatest financial expansion in modern history. And here is where it becomes dangerous for silver stackers who are not paying attention. When leverage unwinds, assets get liquidated, not because they are bad, not because their thesis is wrong, but because margin demands it, because liquidity vanishes, because cash becomes king temporarily during forced selling. We saw a taste of this during the January shakeout, a violent rejection, a spike and a snapback, a move that looked terrifying in the moment, but when viewed on a larger time frame, it was technical perfection, a necessary flush, a volatility squeeze resolving before continuation. If you zoom out far enough, you see something much bigger forming. Silver has been compressing for decades. Generational compression, a coiling spring. Three major impulses separated by long periods of frustration. Patience tested, conviction questioned, stackers mocked, and yet the structure remains intact. When a market compresses for that long, when volatility tightens across generations, the eventual expansion is not mild. It is not polite. It is not gradual. It is explosive. The target that many are too afraid to speak about remains mathematically and structurally intact. Triple digits are not fantasy when viewed against the scale of currency expansion. They are arithmetic. And higher targets that seem outrageous today become logical when denominators are collapsing. But most people are not measuring silver against the right denominator. They are measuring it in currency. Instead, measure assets against gold. Use gold as the neutral yardstick in a world of competing debasements. When you do that, a different picture emerges. Stock indexes that look magnificent in nominal terms look far less impressive when divided by gold. Some have already broken key structural levels. Long-standing trends measured in gold ounces have snapped. Head and shoulders formations, multi-year topping structures, neckline breaches, these are not random lines on charts. They are signals of relative capital rotation. What does that mean? It means that even if an index goes up in currency terms, it can still be losing in real terms. You can make money and lose purchasing power simultaneously. This is the Jedi mind trick of nominal gains hiding real losses. 7 straight months of losses in a major digital asset, when measured against gold, is not noise. It is technical failure. It is capital rotating out on a relative basis. It is exhaustion at higher multiples. It is the market quietly repricing risk. And the dollar itself has broken a trend that held for nearly 2 decades. A long-term support line that carried it through crises and recoveries. When such a structure gives way, it signals something deeper than a short-term fluctuation. It signals erosion of confidence. In a world where every currency is flawed, some are simply deteriorating faster than others. But when the reserve currency begins to weaken structurally, the implications ripple globally. Foreign holders of long-duration debt are no longer the eager buyers they once were. Deficits are growing, issuance is relentless, the burden compounds. And if fewer external actors absorb that issuance, internal absorption increases. That means more monetization, more expansion, more dilution. This is not dramatic language. It is mechanical reality. Now consider collateral. Long-term bonds relative to gold have been deteriorating severely. When bonds fall in real terms, collateral shrinks. When collateral shrinks, leverage becomes unstable. When leverage becomes unstable, forced deleveraging events occur. And when those events occur, everything sells off at first, including silver. This is where many stackers lose conviction. They see red. They panic. They question the thesis. They forget the larger structure. But if you understand that the debasement is ongoing, not coming, not looming, but already underway, then volatility becomes opportunity, not threat. The reset is not a single day. It is not a neon sign. It is a process. It has already begun. Asset by asset, ratio by ratio, trend by trend, the system is rebalancing. And the most important shift is this: capital preservation is replacing growth at any cost. For decades, risk was rewarded because liquidity was abundant and expanding. Now liquidity is more conditional. Debt is more expensive. Confidence is more fragile. In such an environment, tangible monetary assets regain relevance. Silver is not just an industrial metal. It is monetary history. It is the people's money. It is divisible, portable, scarce, and outside the liability structure of the banking system when held physically. Physical. That word matters. Because paper claims are not the same as metal in hand. Derivatives, ETFs, futures, they all introduce counterparty risk. In stable times, that risk seems theoretical. In unstable times, it becomes very real. When leverage unwinds and trust thins, the difference between owning a claim and owning the asset becomes obvious. There are whispers in options markets. Large positions at extreme upside strikes in gold. Bets that seem absurd today. But sophisticated capital does not deploy large sums casually. Extreme hedges are purchased when systemic risk is perceived. This is not about predicting a specific date. It is about recognizing structural pressure. And silver, historically, lags gold at first in monetary repricing cycles. Then it accelerates. Then it overshoots. If gold is the anchor, silver is the slingshot. But here is the warning. Do not be complacent. Do not assume that because you hold some silver, you are automatically protected. Allocation matters. Storage matters. Liquidity matters. Emotional discipline matters. If you are 2% allocated to real assets in a system undergoing structural debasement, that is not protection. That is symbolic participation. You insure your home for full value. You insure your car for meaningful value. Yet many insure their financial future with token exposure to the only assets not simultaneously someone else's liability. Ask yourself, are you positioned for volatility? Or are you hoping it does not come? Because hope is not a strategy. The chronic debasement continues. The bond market has shifted. Major equity indexes measured in gold are breaking down. The dollar has cracked long-term structure. Collateral is deteriorating in real terms. And silver's generational compression remains intact despite violent shakeouts. People are sleeping. They are waiting for a dramatic headline. They are waiting for a single moment they can point to and say, that was the reset. But by the time it is obvious, repricing will already be far advanced. This is the serious warning. Not to panic, not to overleverage, not to gamble, but to understand the scale of what is unfolding. Because what's really coming is not just higher silver prices. What's really coming is a revaluation of everything measured against something real. And if you are not prepared mentally, strategically, and structurally, you will misinterpret the signals when volatility hits. The next phase is psychological warfare. Not tanks, not headlines, not dramatic announcements. Psychological warfare conducted through markets, through volatility, through engineered doubt. Silver does not move in straight lines. It never has. Its role in monetary resets has always been violent, erratic, emotionally destabilizing. It is designed to shake out the weak hands before the structural move completes. If you think the January crash was random, you are not studying structure. It ran a level that triggered stops. It expanded volatility at a critical interim point. It created maximum discomfort. And then it stabilized. On a short time frame, it looked catastrophic. On a quarterly time frame, it looked like a wick. This is the scale mismatch that destroys conviction. If you are trading generational structure on intraday emotion, you will lose. Silver's long-term compression pattern suggests that once certain upper thresholds are cleared decisively, price discovery accelerates through open air. Areas of low historical resistance become vacuum zones. Moves that took years to grind through can be traversed in months. But before that acceleration, there is usually one final campaign of doubt. During that campaign, narratives intensify. You will hear that industrial demand is weak. You will hear that monetary demand is overhyped. You will hear that new technology will reduce usage. You will hear that digital substitutes make metals obsolete. Ignore the noise and watch the ratios. When technology-heavy equity indexes break down against gold, that is capital rotation. When major currencies break long-term trend lines, that is confidence erosion. When bonds underperform gold structurally, that is collateral impairment. When collateral erodes, leverage shrinks. When leverage shrinks, speculation fades. When speculation fades, tangible assets become anchors. There is also a dangerous misconception among stackers that silver will simply skyrocket in a smooth, euphoric ascent. No. The path higher will likely include violent drawdowns, margin cascades, liquidity squeezes, exchange stress, temporary disconnects between paper pricing and physical availability. This is why physical ownership matters. In a stress event, premiums can explode even if futures prices are temporarily suppressed by forced liquidation. Paper markets can reflect panic selling. Physical markets can reflect scarcity simultaneously. If supply chains tighten and investment demand surges at the same time, the repricing mechanism can become non-linear. Dealers widen spreads. Inventory vanishes. Delivery times extend. This is not theory. It has happened before in smaller episodes. Scale magnifies impact. Now consider the global backdrop. Massive deficits, aging demographics, slowing growth, rising interest costs, political pressure to maintain living standards without structural reform. The easiest path is continued currency expansion. Stablecoins, digital currencies, new payment rails, none of these solve the underlying issue of over-indebted sovereign balance sheets. Changing the wrapper does not fix the contents. If you are in a boat taking on water, repainting the hull does not stop the leak. The idea that a digital token pegged to a debasing currency can preserve purchasing power long-term is flawed. If the base currency erodes, the peg erodes with it. The core issue is trust. Trust in the unit of account. Trust in sovereign solvency. Trust in counterparties. Trust in markets functioning during stress. When trust declines gradually, gold rises first. It is the most liquid monetary metal. It absorbs institutional flow. It responds to central bank behavior. Silver follows. But when it follows, it can outperform dramatically because of its smaller market size and hybrid industrial monetary role. A move to triple digits in silver sounds outrageous only when denominated in today's currency mindset. If the denominator weakens sufficiently, the numerator must rise to compensate. The question is not whether silver can move. The question is whether you will hold through the turbulence required to get there. There will be moments when everything sells off, when headlines scream crisis, when liquidity dries up, when you are tempted to convert metal into currency because currency appears temporarily strong. Those moments are tests. If the dollar rallies during a global squeeze, silver can dip sharply in nominal terms. But if the structural trend of the dollar is lower on a multi-year basis, those rallies become counter-trend moves within a larger decline. Understanding time frame alignment is critical. Short-term strength in currency does not invalidate long-term debasement. Short-term weakness in silver does not invalidate long-term revaluation. The system is heavily financialized. Derivatives layered upon derivatives. Leverage upon leverage. When something breaks, the unwind is rarely orderly. But here's the deeper layer of the warning. Do not chase leverage in silver thinking it will make you wealthy overnight. The same leverage that amplifies gains amplifies losses. If you are forced out before the structural move completes, you will watch from the sidelines. Generational moves reward patience and penalize overextension. Silver stackers must think like custodians of purchasing power, not gamblers chasing multipliers. If a major equity index, measured in gold, targets levels dramatically lower than today, That implies that gold, and by extension silver, must outperform significantly over the coming years. That is capital rotation on a historic scale. It will not feel comfortable. Friends and family will question you. Media will ridicule you. Analysts will produce endless charts explaining why metals are relics. And yet quietly, sovereign actors will continue accumulating hard assets. The reset will not be announced. It will be experienced. It will be experienced as declining real wages despite nominal raises, as rising insurance costs, as higher borrowing costs, as asset volatility, as geopolitical tension, as supply chain instability. In that environment, the difference between financial assets and tangible assets becomes clearer. Silver is not a get-rich-quick scheme. It is a hedge against systemic fragility. But when systemic fragility reaches critical mass, hedges can become outperformers. You must also prepare for regulatory shifts. In times of stress, governments adjust rules. They change margin requirements. They alter reporting thresholds. They introduce windfall taxes. They restrict exports. They intervene in markets. None of this is new historically. Preparedness is not paranoia, it is prudence. Diversify storage locations if appropriate. Avoid excessive visibility. Maintain liquidity buffers in currency for short-term needs, so you are not forced to liquidate metal during downturns. This is strategic stacking. And understand this clearly. If silver reaches extreme nominal levels, it will not be because prosperity exploded. It will be because currency units shrank dramatically relative to tangible value. Do not celebrate too quickly. Extreme price targets often coincide with systemic stress. Your goal is not to cheer collapse. Your goal is to preserve freedom and purchasing power through transition. Because that is what this ultimately comes down to. Freedom. Financial autonomy. The ability to transact without permission. The ability to store value outside a leveraged system. The ability to opt out partially from chronic debasement. If the trend in debt and currency expansion continues, and structurally it shows little sign of reversing, then tangible monetary assets regain prominence by necessity. Silver stackers are often early, often ridiculed, often frustrated, but being early in a generational shift is better than being late. The charts are signaling structural change. Ratios are breaking. Long-term supports are failing. Relative valuations are rotating. The process has begun. The only question is whether you will recognize it before it becomes obvious to everyone else. This is your serious warning. Not of a single crash, not of a single date, but of a slow, grinding revaluation already in motion. The illusion of nominal prosperity is fading, collateral is weakening, currencies are straining, and capital is quietly rotating toward what cannot be printed. What's really coming is not chaos for the prepared. It is exposure for the unprepared. Stay disciplined. Stay patient. Hold real value. Because when the final phase accelerates, there will be no time left to reposition.